Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 21st of July. I'm Daniel Lam, your host for the podcast. Despite the wobbles in the exuberance camp, for example, the Korean and Taiwan equities, the Hang Seng Index has held up very well yesterday. It is an index that we've been presenting as a fund rotation beneficiary in the podcast this month. Today, we'll try to look at the positioning for US equities, and that can also shed light for this exuberance camp in general. Now, US equity positioning has drifted lower since the end of May this year. Now, the recent readings have been around plus 0.4 to plus 0.5 standard deviation, and that is a marked drop from the plus 2 standard deviation peak. But the current levels of positioning is still too high, particularly when compared to how prior investor exposure unwinds have unfolded. Now, in 2/3 of prior unwinds, US equity positioning fell below zero before the S&P 500 found the bottom. Now, notice that the equity positioning can go down if there were to be further correction in the S&P 500, or it can drift down via time. So, i.e., the index can quote-unquote digest the positioning by staying sideways or slightly lower, but this process will take time. So, in terms of flow, given the recent price action, the systematic flow picture for US equities shows an absence of the right tail, i.e., positive near-term future returns in S&P 500 is relatively absent. Model-driven investors seem to be biased to the downside right now. Now, the current macro and policy landscape is not so easy for positive US equity returns in the near term. So, for example, the US Economic Surprise Index seems to have peaked. That is measured by the actual data beating the expected data. And this is peaking out. So, this can further dampen the bull camp out there. Now, lastly, seasonal trends indicate a low likelihood of right tail equity outcomes at this stage. So, if you look at investing in US equities in July, that rarely results in material gains historically on a 3-month forward basis. So, all in all, it is somewhat too early to be bargain hunting in a broad scale for US equities at this stage. Now, the factors are still acting in favor of further rotation into the non-exuberance camp, i.e., into the more defensive US sectors in healthcare or financials, as well as the more value plays globally, such as the Hang Seng Index. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.